I'm Chris Preston.
And I'm Brad Simmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network. Uh, Brad, this was a big week for me as my kids went back to school, finally. I think yours have been back since, what, the start of
End
August?
of July. Yeah, about a
End of
month.
July. Wow, that's wild. So we were just talking off air before this. It bears discussion at the top here. Your kids go to school at 7:15, or that's when school starts?
Yeah, my youngest bus comes at like 7:15. My oldest bus comes at 6:44. School for both of them is starting within the 7 o'clock hour. It's way too early for kids, especially growing kids that need a lot of sleep.
I've never heard of this phenomenon. And then Madison, our producer, you can chime in if you want. You said you started going to school at like 7 when growing up in
Yeah,
Florida.
my first class started at 7:05.
That's just wild to me. I was always 8 o'clock growing up in Virginia. Same here in Vermont. My kids around 8 o'clock. Uh, yeah, I wonder if
Your
that is
county likes you.
I guess so. Yeah, I mean Arizona, Florida. I had speculated maybe that's a hot weather thing. Or Brad, you had said, limiting air conditioning usage thing.
Maybe like it's a low latitude thing. That's the other, I mean, but also lack of care about the performance academically or otherwise of kids.
Yeah.
I think is a shared characteristic of Arizona and Florida. So maybe it's just disregarding kids. But I mean, stuff does start early here, like construction. Like you've
Yeah.
got guys on the roof at 6 o'clock in the morning to beat the heat. So there's a lot of excuses for it being like it is, but it shouldn't be. Uh,
Is the traditional work day there not 9 to 5s, like 7 to 3 or not?
if you're, I mean, if you're doing construction or manual labor, yeah, but if you're a
Yeah.
banker,
No.
it's although even like, when I was with Schwab, it was closer to market hours. So I think there's probably some combination of like influence from East Coast business
Yeah.
hours, weather, and then just getting people in sync. It's also, I don't know, probably a childcare burden thing where it's like, hey, if the kids start at 7 and you're going to
Right.
work,
Yeah.
if you're going to work earlier, there's no, we don't have to do any, we don't have to be concerned with daycare because they're just in school. I don't know. It's not great, and it's been this way for 30 years.
Yeah.
40 years? How old am I now? 30 years?
You tell
Uh,
me. Um, yeah, Arizona continues to be a fascinating,
But
baffling thing.
Brad could have started school at 4 a.m. and he still would have come out a genius. So
oh, I could have avoided school and come out a genius.
that's
Oh,
very
wow.
accurate.
What a flex. Okay, well, we'll put you to the test these next 45 minutes. Flex your genius muscles. Let's get to the market. Tell people what we're going to talk about today.
We will talk about last week's Jackson Hole commentary from Jerome Powell to stop the bleeding in growth stocks. Nvidia reported earnings. That was the big event this week. Then we'll talk about the small cap surge and what might be behind it. Whether housing stocks are a stay away, even if rates are maybe getting a little bit more favorable. And then I wanted to highlight Etsy, which has nosedived by almost 25% because of a change to the de minimis rule.
Was Etsy, Madison, was that your pick from a while ago? I can't remember.
Yes, only because I
We
use it
forced you
so
to.
much. Here's the
Yeah.
thing. The last like 3 or 4 times that I've used it, it's been garbage. Like
Oh,
it's really not impressive anymore. So I
Also,
take it back.
interesting.
in fairness to Madison, her pick was before the trade war heated up.
Yeah.
So, and I believe Etsy was at all-time highs as of just a couple of months ago.
Yeah.
So,
Okay. So yeah, if
Indeed.
we
not
went back
not,
and actually measured, maybe it wouldn't be such a bad
not
pick.
all-time highs. All-time highs were way back in 21 during that everything bubble. So,
Multi-year highs though. Um, okay, but before we get to all that, as usual, we start with our defend the take. Brad, you're up this week, and your take, for which you have 90 seconds to defend yourself. is that gold is starting its next leg up and could run another 10% this year alone. Again, you have 90 seconds. Go.
So gold has obviously been a hot trade. It's outperformed the S&P this year. It's really been on an immense run for the last 2 years, essentially since the prospects of rate cuts emerged, and then since what seems to be borderline intentional weakening in the U.S. dollar. Um, one of the sort of one of the things that I don't think is talked about enough, at least by me, um, possibly by others, is that this is not just a concern, that we're not just experiencing a concern with long-term debt accrual by the U.S. government. We're also seeing it with other first world countries globally. So Germany's in a recession. France has some government issues themselves. Gold becomes, with sort of weakening fiat currencies, the next sort of best safe haven. And if interest rates are going to go lower, I think the macro conditions are set up really well for gold to continue outperforming. As far as why I think it may have 10% or more this year, in the first half of 2024, so coming off of the sort of end of its consolidation period until it capped out, it ran 19%. Second half of 2024, from the end of its consolidation period till it topped out, was a 17% run. And then in the beginning of this year, so coming on the heels of the last run up in the end of 24, it was up 31% from the end of its consolidation into its peak.
Time.
And it's been consolidating since April. So it's got 5 months in it, almost 6 months of consolidation. Now's a good time to buy gold. Just hit
It's
new highs
interesting.
above 3,500.
Interesting that it's consolidated since April, coinciding with the run up in stocks. And we've talked on here about how, and I think Cliff Droke, who's our gold metals expert who runs Cabot Turnaround Letter, has talked about how it's very rare that gold prices and stock prices are simultaneously rising. Usually one of them has to bend or break. And he's speculated, I wonder if it'll be gold or stocks to break. I mean, if you're saying gold is going to continue to run up, are you saying you think that stocks could be in for a rough patch, or do you think that they'll continue to run up in tandem?
Stocks are a sort of viable inflation hedge.
Hmm.
Um, I I mean, as much as it pains me to say it, even with the market down like 1% today on the PCE news, I don't really feel like the bear in me wants to scream to sell everything, and like the market's going to crash. I don't really see that happening. There's still a ton of liquidity floating around out there. The on the yield side, right? Like yields and gold move in inverse direction. The short end of the curve, where the Fed can really adjust things with the Fed funds rate, that's going lower. I don't know that it's a great idea, but the long end of the curve, like the 10-year, is up slightly from when the Fed last the last time the Fed cut rates. That's hanging at 4.2%. 30 years, this is one thing that has been on my radar for the US, for Japan, France, UK, Germany. Those are all rising. So the long end of the bond yield curve is telling me that investors are expecting that central governments are going to have to sort of be accustomed to higher inflation rates for longer, or alternatively, that they don't fully trust central governments to not have to offer higher yields, right? Like if the US is what we're at 37 trillion, if we've got to finance a trillion a quarter at the high end of the curve because we need 30-year bond issuances, and that the rates are high, that's not a huge incentive to buy long run bonds. At the same time, it's like if we're going to be offering short-term rates in the low threes, that's not much of a premium. Stocks are already trading at a sort of negative forward yield, uh, based on based on a number of analyses. I think gold is sort of like the last man standing. But there's so much these are really sort of uncharted territories. We haven't had a global
Yeah.
trade war in 100 years. So I'm not willing to say that stocks and gold can't both run up simultaneously,
Yeah.
for the foreseeable future, or especially if we continue to have legs with AI. But I would favor, if I have to pick a winner, I would probably pick gold.
Yeah, I agree with you. I think gold has a better chance of running up 10% from here through the rest of the year than stocks, I think. But let's get into stocks. Today we're doing an expanded, we're doing a starting five rather than a big threes. Lots to talk about. Number one, Jerome Powell, his press conference last Friday, we haven't talked since then, stopped has sort of temporarily at least stopped the bleeding in growth stocks, which were seeming a little ominous for a week or two prior to that. Stocks are back to all-time highs, huge bounce back last Friday after his sort of dovish announcement, which hinted at rates, the Fed starting to cut rates next month, which, the confidence in that happening was sort of waning as my dog enters the room. But now it is at 89.2% chance that they'll cut 25 basis points next month, which is up from 84.7% this time a week ago. That might have been after the press conference, I'm not sure.
Yeah.
And 63.3% a month ago. So it's way up. People are pretty confident they're going to cut rates starting next month and that they're going to slash rates at least twice. That's the majority opinion by the end of the year, 48.4% that they'll slash rates twice, 25 basis points each by year's end. I guess we sat here last week and said, yeah, you thought that maybe he might throw some cold water on the rate cut thesis, and he sort of did the opposite. Did this change your thinking of the Fed's approach?
No, not a ton. I mean, like GDP, Q2 GDP, the first revision came out earlier this week. It was revised higher to 3.3%. But if you control that for imports, exports for the first 2 quarters, it's sort of an annualized run rate for GDP at 1.4, which is up from 1.2 before that revision. They made a point that the risk is to the labor market. I don't know if like they did the same thing when inflation was transitory, but transitory meant 18 months, not a month. So there could be a higher likelihood that they see the inflation risk from tariffs as being a 1 to 2 year prognosis, and that there's enough concern about the labor market that they're cutting rates. The thing that where I think the stock market is sort of missing the forest for the trees is you don't cut rates into a strong economy. Um, I don't obviously nobody knows exactly how much of a political thumb is on the scale with this, especially in light of the news of Cook being fired or attempted to be fired. There could be an element to, look, we want low rates. We're getting low rates are coming regardless of, so I need to sort of spin that in the most positive way that I can. Um, yeah, I don't know. The PCE coming in hotter this morning doesn't scream it's
Yeah.
time to cut
Uh,
rates to me, but what do I know?
yeah. I mean, you say hotter, it's mildly so. Prices rose. So PCE was 2.6% in July, um, which is the same as June. But if you exclude food and energy, 2.9%, up from 2.8% the previous month, and the highest since February. We're
Yep.
still not in the 3%, north of 3% range here, even though it's been very slowly ticking higher. But yeah, you might be right that there's the fears are further down the road. Fears of inflation returning are further down the road than, some have been speculating as a result of tariffs.
Well, I
Um,
think Bank of America, I think, has a year-end target for inflation and above 3%. Um, I think there's a frog in the pot element to this, where the market is sort of just getting gradually boiled as inflation rises, and then I don't know, maybe we get a September cut and no December cut, right? It's it is it's real. I think it's only going to be really clear in hindsight. The same way that the soft landing element was unclear until a year after the Fed took the positions that they took, started cutting when they did, right? Like in hindsight, at the time, everybody was critical. Um, in hindsight, looks like they played their hand pretty well. This could be more of that. Maybe there's more risk to labor than what we're seeing. The Fed has access to a lot of data. There are concerns about rising levels of estimated data in inflation as well, simply because of staffing issues. So in the past, the Fed would send out analysts to grocery stores to collect prices, right? But there's been a huge spike in the amount of estimated data that they've used because they just don't have the people to put boots on the ground. I'm not saying that that is something that is fundamentally problematic, but data granularity suffers a little bit. You get maybe a fuzzier picture of what things look like. Um, if I were a voting member, I wouldn't be voting for rate cuts right now, but I'm not. Um, I wouldn't be stunned if we don't see one in September. I mean, at this point, the market is we are close enough that the market probably has it right that they come out and cut. I do think that the terminal rates stay a little bit higher than maybe we would have expected earlier this year. I wouldn't be stunned if we only got a September cut and then they kick the can into 26.
Yeah, I thought that they would cut starting in September, the second that July jobs report for the second straight year came out weak, even weaker this year, or at least the May, June downward revisions were really sort of appallingly weak. Similar to last year, everyone was like, "Oh, the Fed wait too long to cut rates," and sure enough, they came out of the gates hot, 50 basis point cut in September, tricking the market into thinking that that was going to be sort of the norm for the ensuing year or whatever, and in reality, that matched the remaining rate cuts in the year since then. But I've thought that because of that report that the Fed would start cutting in September, and I think I'm going to stick with the majority here. I guess the sort of easy safe answer that they'll cut twice, 25 basis points, the rest of the year. Beyond that, who knows? But let's move on to the other market moving or potentially market moving event from this past week. Nvidia earnings didn't really move the market. They were sort of a mixed bag, beat, but in sort of a run of the mill way, not in a very Nvidia like beat, which they've raised the bar. This is what happens when you raise the bar so high. People expect you to blow earnings out of the water every time. Well, it came in at an adjusted $1.05 per share versus $1.01 estimate. Revenue 46.74 billion versus 46.06 billion estimated. So like kind of a narrow beat. And Nvidia's down a bit since then. Overall revenue rose 56% in the quarter, which is pretty good. 9 straight quarters now exceeded 50% growth dating back to mid 2023. So basically aligning with the generative AI boom. But it doesn't seem like Nvidia's success is as nearly as tied to the markets as it was a year or two ago. It might have been about a year ago. We were on here saying, is Nvidia too big? Is it have too much influence on the market? And that was when the rally was still super thin. That it was basically like the Mag 7 and large AI, big tech type stocks. It's still fairly thin, but it's not it's broadened out since then. So maybe that's why, and maybe just the shine has come off of, Nvidia was sort of a shiny new toy back then. Now it's not as much, and also now it's not, blowing earnings out of the water the way it was. I feel like ultimately that's a good thing that Nvidia earnings aren't like the make or break that they were for the market. What's your take?
Yeah, I mean, it's a $4 trillion company. Ahead of earnings, the options market was pricing in a 6% move, either up or down. Instead, Nvidia closed yesterday basically flat. It's down 2% today. We shouldn't be able, or the market shouldn't be in a position where it's swinging $4 trillion companies by 6%, right? Like that's
Right.
so much. That's just a lot of market weight to try and move. Um, yeah, we'll talk about small caps, but those had been outperforming a little bit. I think I think there's a limit to Nvidia's upside at this point. Their data center revenues, 41.1 billion, was a little bit lower than the 41.29 billion estimates were at. Margins took a little bit of a hit. I mean, like, what's the upside case for Nvidia right now? Jensen came out in the earnings call and mentioned that data center spending, CapEx spending, could be as much as $4 trillion by 2030. Um, they're already sort of spending at that pace. 59% of Nvidia's revenues come from three customers that they don't explicitly name, but they're presumably other members of the Mag 7.
Hmm.
Like there's no catalyst to like drastically change their growth prospects. And even if, so they had what, 46 billion in revenues this quarter. I think they're estimating 50, 54 next quarter. So if they're growing revenues at 10% a year, we would expect the stock price to rise at 10% a year, everything else remaining the same, assuming their margins don't compress and they don't have another way to improve profitability. So it's priced in all the good news. Obviously the risk to Nvidia is that one of those three customers that make up 2/3 of their sales decides to shut off the money faucet on data center spend, or alternatively, that we hit a bottleneck elsewhere in that data center process, right? Like there are actual throttles that are potentially in place, whether it's the enough power, whether it's enough land, whether it's approvals, right? Like there's all these sort of like grimy details of the real world that can slow down some of the spending. Um, it seems to have priced in all the good news and no downside risk or no bad news. So I don't think it has a lot of juice left in it. I
Yeah.
I have not been an Nvidia acolyte for quite some time. I think as people will know. So you can keep
I
that in
think
mind.
it's fallen into the romance phase is over
Yeah.
with the company. It's just sort of an ordinary Apple, Amazon, maybe I'll give it a little more credit than that, but fallen into the a good growth stock to have in your portfolio for probably years to come, and will probably outperform more often than not in the years to come. Um, but isn't We're not going to see the same type of outperformance we've seen the last couple of years from it. It's sort of becoming more of a ordinary big tech stock in line with Apple, Amazon, Meta, etc. And I don't think that's a bad thing. Um, I think you would do fine if you invested in Nvidia now
So
and help the next 5 to 10 years. But
speaking of investing in Nvidia, one thing that we didn't discuss, they also announced a $60 billion buyback.
yeah,
Normally the market responds pretty well to that, but the sort of double edge of that sword is if you're doing a $60 billion stock buyback, that means you don't see as a, as a management team a clear place to deploy that capital where it's going to generate a better return than
yeah,
just owning your own stock and consolidating earnings into shares that you have in treasury or canceled or however you are treating that buyback or using for, stock-based compensation for employees, right? Like that, I don't know what, other than just stacking chips, I don't know what their next great growth objective is. And I think the
Yeah.
buyback sort of reinforces that.
Buyback is a tell of a company that's, knows its growth isn't going to wow people anymore. Yeah, I mean, you want to say, that it never will again, but knew that at least this quarter's wasn't going to wow people. And that they need to do, pull some levers to get investors interested again, or as interested, half as interested as they were over the past couple of years.
Yeah,
Um,
Apple announced buybacks in May of 24, $110 billion.
mhm.
Um, they were trading at that level for, April, May, June. It's only their recent pop that has them trading above that level a year later. They're up 20% since they announced their big buyback. So it's obviously, a sizable move, but in the context of strong market performance for big cap tech anyway.
Yeah, and Nvidia is not as far removed from its, greatest period of growth, nearly as Apple or Amazon or any of the companies I've mentioned, certainly Tesla. But I think sort of the romance is over, and I think the market's being so tethered to Nvidia is also kind of over, and I think the market's better for it. Okay, let's move on to one thing that or asset class that got a bump from Powell last week, at least initially, was small cap stocks, which were up more than the market in the ensuing days. After that, since pulled back, small caps tend to be more volatile. Um, since the announcement, they're now roughly flat, but they are up 5.5% in the last month, as sort of the narrative of rates being cut has improved. And I'll take you back to a year ago, um, when I think we sat here, probably had Tyler on, when small cap stocks were up more than 20% from start of September or after about the first week of September. There was a down week that first week after Labor Day until roughly the end of until Thanksgiving. Small cap stocks, as measured by the Russell, were up more than 20%, more than 25%. Um, and that was the peak. They're down, they were down a lot from November, certainly through the start of April. And while they've been on steady rise since April, actually outperforming large caps since the start of April, um, they are still below that November 2024 peak. And that November 2024 peak was almost identical to the November 2021 peak. So it'll be really interesting to see the real test for small caps. I think will come in the next month or two to see if it can push above. I mean, the Russell, the resistance is, the peak level is about in the 2440 range. It's right now 2363. And again, that was the peak around in 2021 and a year ago or last November, I should say. Um, do you think we can trust this small cap rally? I mean, the last couple of days would already tell you no, but we were giddy about like finally small cap stocks, which underperformed for years. Maybe they're finally going to outperform large cap stocks, and they haven't. I think in large part because, as we mentioned earlier, the Fed did not, you know, put their foot on the gas with rate cuts. That they, turned the water off there by the end of last year and haven't cut since. I guess the answer lies in how confident we are that the Fed will continue to cut rates beyond the next few months. I think if they continue to cut them for the next year, sort of steadily or at least periodically, then small caps have the potential to outperform. If not, if it's another sort of false start or, temporary thing, then small caps, this might be a short-lived rally again. Is it as simple as that with small caps, do you think?
Yes.
Yeah.
Yeah. So I'm perpetually, I say perpetually, but you know, I have been for some time overweight small caps. I think
Mhm.
small caps are undervalued in light of the objective getting short-term rates lower. Um, right now, just looking at performance, Russell 2000 up 10% in the last 6 months, up 5.4% in the last month, as you said, versus the S&P was up 9.2% in 6 months and 1.8 in the last month. NASDAQ up 15% in the last 6 months, 2.5% in the last month. So in the last month, small caps, as measured by the Russell, have outperformed by double the
Yeah.
NASDAQ and big, well, not Mag 7 tech, but the NASDAQ as a whole.
Mhm.
If you look at forward PE ratios, Mag 7 is 29.3, right? Like if their growth is there, I mean, I guess you can justify that kind of forward PE. I don't love it, but nothing I can do about it. S&P as a group, though, 22.2. So they're sort of historically overvalued. The small cap, the SP small cap 600 trades at a forward PE of only 15.7. That's more in line with historical averages,
Yeah.
but that's a 6.5 multiple gap. It's the largest gap in PEs in forward PEs between the S&P the S&P 500 and the small cap 600 since the 90s, and
Wow.
it's been persistent since the pandemic era. Um, so when the pandemic hit and the market sold off, small caps underperformed as you would have expected, but they never rebounded the same way that large caps did. It's because they were capped by high rates.
Right.
When rates come down, small caps will go higher. My long-term perspective is overweight. When I say overweight, I don't mean I'm 100% small caps. I mean, instead of 15%, I'm 20% small caps. But yeah, I think small caps are a smart place to be over allocated. You might have to wait on, like we were saying earlier, inflation might take 18 months to get through to the point where like rates can actually start like coming down.
Right.
But if we are assuming that rates are going to head back towards sub 3%, small caps will outperform.
Yeah. I think that's, yeah. And the reason behind why they're so, small caps are so rate dependent, you'd probably do a better job explaining this than I would. I mean, so many small cap stocks do most of their business in America. They're not, large caps have multinational operations often and are not as tethered to or dependent on what the US rates are, right?
Yeah, their borrowing rates are what's critical because the smaller
Yeah.
companies typically don't have large cash cushions. They are investing for growth. When you're investing for growth, you are losing money. Like look at a biotech, right? A biotech may be just burning money while they're in the R&D phase, but already public, in the hope that they sort of take off. But it is expensive to launch and operate a business, and you have to go through a period of pre-profitability. So for small caps, financing costs are really, really important. And right now, financing costs are high. So it makes it harder to succeed. If you are a small cap company, you're more likely to not have the length of runway that you need to finally turn a profit or to reach success. There's other like structural stuff that is happening where we've seen fewer companies coming public and more companies that are
Yeah.
trading under sort of private round funding for longer. That could change the calculus a little bit, but the biggest lever for small caps is short-term interest rates. When rates come down, small caps will have more room to outperform.
Okay, we'll get to a couple more topics. First, I want to tell people about our offer we have for today's listeners. It's a good one. If you go to cabotwealth.com/street, we have our Labor Day sale going on where you can get subscription to Cabot Prime Plus for $2,000 off the normal price. That's $14.97 for the year, for 1 year, and a 30-day 100% money back guaranteed if you want to try it out for a month and see if you like it. This is for first-time subscribers. The offer expires Monday, September 1st, Labor Day, at midnight. What you get is access to 14 of our best investment advisories. That's most of our investment advisories, which individually are valued at $13,358. So again, you could get this for $1,497 for a year. You get access to Cabot Growth Investor, Cabot Top 10 Traders, Cabot Small Cap Confidential, Cabot Early Opportunities, Cabot Cannabis Investor, Dividend Investor, Income Advisor, Turnaround Ladder Value Investor, Stock of the Week, which I run, Cabot Explorer, our global investing service, Profit Booster, which is options trading, Money Club, Retirement Club. You get access to all that. You also get a bunch of special reports and access to all of our analysts, email access to all of this for any questions you have. We get quarterly analyst calls, which everyone is on. So again, if you want to subscribe to Cabot Prime Plus for $2,000 off the normal price, you get all that for $14.97 for the year. And that's through Labor Day at midnight if you go to cabotwealth.com/street. And we'll have that link in the blurb on our YouTube page. Okay, let's shift to our last couple topics here, starting with another Fed rate cut dependent sector, and that's housing, of course. The housing stocks have popped, home builders have popped since Powell's dovish press conference last week. Housing stocks were up quite a bit last year. I wrote about this in my Cabot Value Investor issue this week. They've been beaten down over the last year, down 3% as a group, which is the second worst performing sector in the last year. But the last time they got a real bump was last July through about mid-October, ahead of the Fed starting to cut rates, and after they did most of their rate cutting last year. But overall, home builder stocks have been down in the last year plus, and with good reason. Let's see. So sales are down anywhere from 30 to 40% in the housing sector from their peak. The peak was early 2021, early 2022, that range, not coincidentally, before the Fed started hiking rates. And you would think that the sector would be cheap, but it's not. In fact, on a forward price to earnings basis, it's the most expensive of the 11 S&P sectors right now. Second most expensive on a price to sales basis, and about middle of the pack price to book value. But are there any deals or values within the sector? Well, there are a few big names trading at ostensibly decent value. Toll Brothers, forward P of around 10, price to sales 1.3. Pulte Group, PHM, forward P of just under 12, price to sales 1.5. DR Horton, DHI, forward P 13, price to sales 1.5. But not one of them is projected to grow. I think Toll Brothers is expected to grow like 0.05 or 0.1 or something, sales or earnings, either this year or next year, which tells you everything. Now, if the Fed really cuts rates a lot in the next 18 months, then that would probably change that calculus there. And then at that point, maybe it'll be a good time to buy home builders. But right now, with them being the most overvalued sector, and also at a time when sales are down 30 to 40%, I think unless you're have more of a trader's mentality and want to capitalize on, a multi-week or maybe multi-month rate cut bump or renewal of rate cutting bump in home builders, I think they're still a stay away. What's your take?
Yeah, I would agree with you. I think that's a good assessment. Even if you're maybe like a longer term investor, I think there's probably a better entry point in the future. Um, specifically, if this is like a new normal, right? The housing market has been fairly frozen,
Mhm.
partially because prices are still high, and partially because a lot of people that bought it during that pandemic era are locked into super, super low rates. It'll take a while to get those rates out of the system. We've seen some progress on that front because, life happens. You have to move. You have to give up that sweetheart deal of a rate at some point for a lot of people. But people are going to be homeowners specifically are going to be really resistant to do that, even to the point of probably becoming like accidental landlords. Um, if rates stay high, right? And when I say high, I mean high relative to the last 15 years, because we've really only been dealing with zero Fed funds rates since like 2008, right? Since
Yeah.
the Great Recession or the Great Financial Crisis. Um, the normal before then was Fed funds rate closer to 3%, mortgages closer to 6.5, even higher in the 80s. If
Which is
that
where they've
becomes
been north of 6%. They've been stubbornly since basically late 2022.
Yeah, if we get a return to that sort of normal, um, I like home builders a little bit in that they have a high degree of flexibility for offering like financial promos, things like that, where they'll do rate buy downs as part of it. It'll hit margins, but they're actually pretty well insulated for tariffs or from tariffs. In 2024, the National Association of Home Builders estimated that there were $184 billion worth of goods that went into newly built homes. But the impact of tariffs on that would have been about 3.6 billion, so about 2%. Because, a lot of the inputs to housing we can source locally or they're not subject to high tariffs. So even if we are in an environment of like high persistent tariffs of 10, 15, 20%, whatever for the foreseeable future, they're actually not going to be negatively impacted that much. So I don't like them now. I will probably like them in a year or year and a half once we get some
Totally
resolution
agree.
to the rate stuff.
Yeah. Yeah, I could see, Fed cuts rates another 100 basis points. It's one thing them cutting 100 basis points from what, 40-year highs. It's another thing cutting another 100 basis point, from that initial cut that, then now we're getting somewhere, and now there's a chance that mortgage rates could get below that six, stubborn 6% level, where it becomes more appetizing to people who are, like you said, locked into a low rate. Like, okay, well, I'm not going to get as good a rate as I had, but my home price has appreciated, a lot since then. And rates are, say you got a 3% rate or something. Now you get a 5.5 or 5.75% rate. It's still much higher, but it's not like it's 6.5, 7%. Might make things a little more attractive. Um, and the Fed may continue cutting even more than that. We'll see. But I agree that I'd give it, unless you're trying to make a quick buck over the next month or so, I'd give it, yeah, probably a year.
There, there's also structural tailwinds for home builders. The country has been underbuilding since '08, so there's a shortage of inventory. There is perpetually a shortage of inventory. Um, if we have higher inflation, presumably we're going to have higher wages, which are going to outpace or is going to recoup some of that overpricedness of existing housing inventory. So, right, like my $600,000 house is looks overpriced now, but after 2 years of 3.5% inflation, then it looks less overpriced, right? Assuming that you get commensurate wage boosts as well. So you can sort of digest some overpricing in housing, especially with tight inventories. Um, that's a structural defect that I think benefits, right? Like all the NIMBY stuff and YIMBY stuff, like all that homeowners benefit from some structural deficiencies, perpetual weakness is good for housing prices. That's the biggest investment for most middle class households, right? So there's no reason to specifically do away with that. Um, I think that is supportive of home builders over the long run, just not yet.
This stat says it all. Housing starts peaked at 1.82 million in April 2022. They're off about 30% since from those highs. Stocks, home builder stocks have nearly doubled in that time. That to me is why they're a stay away. And that's why they're the most overvalued sector out there, despite being, down in the last year. There's a big gap between the values of home builder stocks right now and what those home builders are actually doing in terms of sales and earnings. And I don't think that'll be fully corrected for at least a year.
What was the number of housing starts that you just quoted?
1.82 million,
Okay.
which the low was 1.28 million this May. We're a little higher than that now, but not much.
So that actually is not too far off. I was looking at household formation in the US. That's around 1.2 million a month. So even if your housing starts numbers are consistently within a few hundred thousand of household formations, you're not really making a dent in the existing undersupply. You're just barely keeping up with the demand for new supply.
Yeah,
The boomers down trading down maybe has an impact on all this, but I think on the long run, this just the way that this country is sort of set up and economically is sort of good for home builders and it's likely to stay that way. I had a law professor that used to joke that um, you know, there will always be a need for lawyers in this country because the lawyers make the rules. The corollary of that is that it's always a good time for home builders in this country because most of this country profits when home builders are doing well and real estate's doing well.
right. I think you just dropped a real estate related okay boomer in there, but we'll move on. Last subject. This is all you. Etsy off what 25% in the last 2 weeks. Tell us what's behind that. And yeah, Matt, we won't fault you, Madison, for picking Etsy earlier in the year because, like we said, it did hit all-time highs or multi-year highs a couple months ago.
So the specific catalyst for this was the end of the de minimis exception. That's something that's been talked about for quite some time. It's essentially you can ship an individual or a small business can ship a product to the US as long as it's below $800 in value. And you can avoid tariffs, you can avoid like any kind of filing or consequences or anything. As long as you're just sending small amounts of product into the US from internationally, no harm, no foul. Well, the de minimis exception ends today, which means that all of the small sellers on Etsy that operate internationally that ship to the US are going to have to deal with tariffs, tariff paperwork, all these sort of administrative hurdles of moving stuff around the globe. The thing about Etsy selling off 23%, though, is if it weren't coming from such a high base,
Yeah.
I would consider this to be an overreaction. When I say high base, Etsy is trading. I think when I looked yesterday, it was trading at like 40 times earnings. So obviously, it's richly valued already. But 38% of their sellers, of Etsy sellers, are international, at least as of the last numbers that I was able to find. And 60% of buyers are domestic. So it's not as if this platform is trading at 43 times earnings. It's not as if this platform is built entirely on US consumers buying goods from overseas sellers. There's an intersection there, but the intersection is probably like 20% of their product. They shed a quarter of their value in 2 weeks. Rich valuation aside, I think it's an overreaction, although Madison saying that the last couple of times she's bought anything from Etsy, it has been a really bad experience. Might have me second guessing that. but I do think it's a little bit of a overreaction. I don't know if I would buy it here, but I think if you liked it coming into all this, you can probably safely still like it.
Yeah, it was stock's still up slightly for the year, just under 2%. But down about 3% in the last 12 months. Man, I didn't really it's off 55% in the last 5 years. Peaked, surprise, surprise, November 2021, when everyone was online and using Etsy, probably.
Oh yeah, there was the crafting boom too. I had
Yeah.
totally forgot where everybody's like, I'm gonna make sourdough bread and I'm gonna darn mug holders or whatever. I forgot about that.
Yeah. Yeah, this from, about over the course of about a year, the stock went from in late 2021, about 118 to 294, trading at 53 now. Uh, yeah, I don't have a strong opinion on Etsy, but 23% in 2 weeks on de minimis, what a word that most people don't
De
know.
minimis.
Uh, seems like a overreaction. Still don't know if I would buy it here, just given its track record. But
I
yeah,
would I'll put a specific number to it. It's like a mini defend the take. I like Etsy over the next 6 months more than I like home builders over the next 6 months. So if we wanna
that
check this,
that I can agree with. Okay, let me mark this down. Etsy,
Etsy
is
versus
that
the
like
IHB
XHB
or
or
XHB, yeah,
ITB, either one. Um, next 6 months. What's the date? August
August
29th.
29.
Brad, when we were going through a crafting boom, how many loaves of sourdough did you make?
None.
I don't believe you. I believe you're a closet sourdough baker.
I no, I don't like it's the nurture thing. I can't nurture a sourdough starter. Like I can bake bread. I do it fairly regularly. I cook a lot. I can make really good pretzels, soft pretzels, but nurturing a starter for like 6 weeks to also my family doesn't like sourdough. I think maybe
Wait,
that's
it
the
takes
answer.
6 weeks.
I don't know, however long it takes to get your starter up to the point where you're happy with it. I don't know how long that
I
takes.
don't, you're the
But you have to like
sourdough expert, not me.
it's a house plant. You have to feed it fresh water and flour every day. Nobody in my family likes sourdough, and I don't eat enough bread to justify it, so I'll just not ever make it.
Fine, but I bet if you did, it would be the best sourdough that the world's ever seen or had.
My pretzels are really good. Uh, my soft pretzels. Alton Brown's soft pretzel recipe for any bakers out there. That's a game changer football food.
Start the podcast with school wake up times, end it with sourdough nurturing. Is that the term you used? Nurturing.
Yes.
You know that was the thing.
Yeah, there's been another episode of Brad's Homestead Corner.
Yeah. I think this feels right. Good place to end. And good question, Madison. I'm glad you pushed Brad on that, on his crafting.
You
Or
know, I'm always trying to get his secrets.
Yeah. Well, we'll have more on sourdough nurturing next week, and maybe investing. But thanks for joining us this week. And that's been another episode of Street Check. Like and subscribe as always, and we'll see you again next week.